Good afternoon, all of you. Yes, good afternoon, all of you. Am I audible? Okay. Today's strength still not joined. Students still not joined today. Right. Today's class, we are going to discuss about RBI, Reserve Bank of India. Yes, I have small. Before that, we also go to banking reforms, right? Banking reforms in India. Is the screen visible? Hope you all can see banking reforms. Yeah, reforms in banking sector. What are the reforms in banking sector means? Generally, after liberalization and growing trends, according to the trends, globalization is increasing. Liberalization has been introduced in foreign trading or banking activities and all. So certain reforms have been introduced in India in order to improve the banking operations more efficiently and effectively. Okay, so there came into existence certain reforms that are introduced by certain committees. Okay, so you may why means just now I said with the globalization and liberalization, in order to improve the banking sector operations more efficiently and effectively, and make the financial transactions of the country more health means developed activities, and development of upgrade the activities of the banking sector. These reforms have been undertaken. Same have been mentioned here. Objectives of banking reforms. Objectives of banking reforms, if you can see. First one is enabling measures, strengthening the measures, and institutional measures. Enabling measures means designed to create an environment that bank could respond optimally. Enabling the measures, that is, commercial banks can make their according to the changes. They can make their business activities or banking activities more effectively and efficiently. In the terms of lending, interest rates, all these have been to make more effectively. They came into existence. The next, strengthening the measures means reducing, in order to reduce the vulnerability of the banks in the economic environment. Vulnerability means, see, they have various loans. When they give the loans, they face non-payment of loans or repayment of loans by the customers. In such case, the non-performing assets will increase, and then the cash asset, the capital, whatever, the funds, whatever are given as a loans, will get locked by these non-performing assets. In order to minimize such kind of non-performing assets, and to make the what is income, and where they can get a good returns, and where they can make investments, okay, and where there is a good capital adequacy, in order to make all these more stronger, these reforms have been undertaken. Next, institutional measures means banks earlier used to conduct only certain kind of activities, but as per the requirement of the economy, or the changes in economical conditions, or technology, globalization, and growth of the customer requirements, a need for development, all these has led to the reframing of a banking sector, including with their other activities. They are supposed to requested to involve in developmental activities, and where reforms are required in order to bring. When they are involving in that, automatically legal framework is also important. When the when banks involve in the other activities, so the institutional framework of development banks needs to be developed. The salient among those include reforms in the legal framework pertaining to banks and certain new institutions. So without the legal framework, whatever the new activities they involve and they undertake, that will get a difficult to face the legal obligations. So with these three objectives, banking reforms have been taken place. If you see the components of banking sector reforms, granting means in what aspects they are undertaken these, like granting operational autonomy to banks, reducing the statutory pre-emotions to release the greater funds, deregulation of interest rates, relaxation in investment norms for banks, and easing of restrictions in respect of banks' foreign currency investments, like when they are doing the foreign currency investments, they may ease the restrictions over the banks. Withdrawal of reserve requirements of interbank borrowings. Yes, actually, in previous class also I mentioned that banks have to be maintain certain reserves, and within the branches they can make those changes among those bridges. Okay. Next one is introducing prudential norms in line with the international best practices, allowing entry of new private sector banks and an enhancing presence of foreign banks. These all are the components of commercial banks. Right? So let us see the next one. Yes, Nasmum Committee. The first one is the Nasmum Committee, where in 1998, the not first one, there's an important one, Nasmum Committee's report 2, this one is. I'll tell the other one. Components we discussed now. So after this, components. Yes, this one. Yeah, similarly, revamping of supervisory system of creating a sound banking system, strengthening the corporate governance practices and disclosure standards of banks. With all these objectives, these reforms have been undertaken. So, if you see, if the first reforms were made by the Nasmum Committee in the year 1991. So that's the very important committee which brought various reforms in the banking sector by their report. So first one is establishment of four-tier hierarchy for banking structure with 3 to 4 large banks. At the top and bottom, rural banks engaged in agricultural activities. So first point they mentioned, the recommendation they gave is make it as a four-tier hierarchy for banking structure. Means a four-level hierarchy must be there. Agriculture bank, rural banks, then other the branch bank and head bank. Like that, 4 levels, the hierarchy should go. It should not be beyond that four levels. So that by when this hierarchy at the 4 levels, the activities and functioning of these banks can be controlled. The next supervisory functions over banks and financial institutions can be assigned to a quasi-autonomous body sponsored by RBI. Yes, generally when four-tier hierarchy is there, the supervision functions of banks, whatever are there under these 4 tiers, can for the banks or the financial institutions, a quasi-autonomous means it's not total autonomous. It this autonomous body, whatever is there under the RBI, again will control the will be under the control of RBI. But under the control of RBI, this quasi-autonomous body again will control these banks and financial institutions. That way, we can make a more efficient work. Can get the more efficient work is what the Nasmum Committee recommended. Next, a phased reduction in statutory liquidity ratio. Yes, statutory liquidity ratio has to be reduced slowly one after the other. Means slowly it has to be brought down instead of maintaining reducing at a time. Okay, here phased achievement of 8% capital adequacy ratio. Yes, capital adequacy ratio must be 8%. That also has to be reached slowly in a phased manner. Means slowly it should be increased. Abolition of branch licensing policy, branch licensing policy. And next they said licensing policy, like in order to introduce the new branches by the main office or head office, they need to get a license. That has to be abolished. Banks has to be given freedom to open their branches at their convenient places. That freedom has to be provided, is what they mentioned. Proper classification of assets and full disclosure of accounts of banks and financial institutions. Yes, assets has to be classified properly, and all the banks and financial institutions has to disclose their accounts. Is another recommendation. Deregulation of interest rates. Again, these banks has to the interest rates have to be deregulated. Means that there's given freedom. Banks should be given freedom in fixing their interest rates. Delegation of direct lending activity of IDBI to separate corporate body. Like IDBI is whatever lending activity is there, that direct lending activity instead of for IDBI, it should be undertaken by a separate corporate body. That is what the other recommendation. Competition among financial institutions and participating approach. Yes. Financial institutions, again, among the financial institutions, the competition, whatever is there, that should be in a participating manner. And finally, asset reconstruction fund to take over portion of the loan portfolio of banks whose recovery has become difficult. Yes, means they are instructing the banks to maintain a fund called asset reconstruction fund in order to get the what banks give loans, right? Some loans getting recovery of some loans gets difficult. So in such case, for such difficult loan recovery cases, this asset reconstruction fund will be helpful. That is what their recommendation. So banks should need to maintain asset reconstruction fund. These are the recommendations they give. The main recommendations are regarding, I'll repeating again, the main recommendation is about establishing the banking quartile hierarchy and establishing a quasi-autonomous body to supervise the banks and financial institutions, reduction of statutory liquidity ratio in a phased manner, improving the capital adequacy ratio in a phased manner, abolition of branch licensing policies, deregulation of interest rates, and competition of means participating of competition among the financial institutions must be in a participating manner, and banks are instructed to establish or set up an asset reconstruction fund in order to meet the difficult loan recoveries. Okay, these are the reforms that are introduced by banking sector government, introduced by the Nasmum Committee. Okay, so if you look into this, what you call banking reform measures of government. So based on these requirements, what are the measures that the bank has taken, government has taken forward in order to do this? In the implementation of these recommendations, what measures the bank has taken. On the recommendation of Nasmum Committee, the following measures have been undertaken by the banks, government. So what are those reform measures? First, lowering the SLR and the CRR. Okay, lowering the SLR and the CRR. CRR means cash reserve ratio. SLR means statutory liquidity ratio. Okay. SLR is statutory liquidity ratio. CRR is cash reserve ratio. If you see the lowering, what the recommendation there is, the phase manner SLR has to be reduced. So they started reducing the high SLR and CRR reduced. Why? Now you should understand what is this reserves. Yesterday I explained you about money multiplier, right? The how commercial banks create credit, right? So how they created credit? What one actual cash deposited 100, but multiplying it different times, they made the deposit showing as a 4 times more than the 5 times more than the actual deposit, right? Okay, but what government has instructed, certain percentage of their deposited money has to be kept aside as a reserve. So SLR used to be see, SLR used to be up to 25 to 38% in the beginning. We are talking at the time of 1991. At the beginning, it's going to be 38%. So majority out of 100 rupees, 38 rupees they are supposed to keep aside under SLR, and 15 rupees they are supposed to keep aside as a CRR. So total 50 rupees if they keep aside, with the remaining 50 rupees, what the business they do, how they meet their expenses, how they can circulate the money, right? It's going to be difficult. That's the reason why the committee has recommended to reduce the SLR and SCRR in a phased manner. So as a part of that, the government has undertaken a reform to reduce the SLR from 38% to 25% in 1997. Okay. And the CRR, cash reserve ratio, SLR means statutory liquidity ratio, which is supposed to be kept with the RBI, and CRR is the cash reserve ratio, which banks keep with the amount which they keep with them. Okay, so these are reduced from. Yes, these are reduced from the time to time. At that time, automatically 38% to 25% they reduced, and CRR they brought down from 15% to 4% in the 2003. The present SLR, if you see, the present SLR is 18% again, 18%, and CRR is 4.5%. Okay, the present SLR is 18%, and what do you call CRR. That means out of 100 rupees, they are supposed to keep 18 rupees as a statutory reserve, and 4 rupees 50 paisa as a reserve, cash reserve, to meet their immediate expenses. The remaining they can use for getting loans. Okay. The next one is. Next thing is that I hope you all are able to see. Is screen visible to you all? Yeah. Next one is prudential norms. Yes. Prudential norms, like the norms, whatever the required. Prudential norms have been started by order RBI in order to impact the professionalism in commercial banks. Okay, proper disclosure of that means the banks are also requested to disclose their accounting details, that is income details, so that they can maintain their records professionally and with the interest of the public and the customers dealing with the banks. They asked, means banks were asked to disclose their income reports, okay, and their assets details, how they are classifying their assets, and what is the criteria for provision for bad debts they are creating. All these details are supposed to be reflected in their financial records, is what the rule implemented by the RBI. Okay. The next one is yes, non-performing assets. Non-performing assets are those assets which taken over in the process of loan recovery, whatever the fixed assets taken over by the banks, and those assets when cannot generate any revenue to the banks, we call as a non-performing assets. The next one, capital adequacy norms. Capital adequacy is the ratio of minimum capital that is supposed to be kept by the banks in risk asset ratio. Okay, RBI, this ratio has been fixed by RBI as 8% in 92. Then Okay, public sector banks have reached the as a 8%. What they said in the recommendation, capital adequacy has to be improved in a phased manner to the in a phased manner up to 8%, right? Right. Now it is 10.5% at present. I think it is going to be at present this capital adequacy ratio is 10.5%. Those days, as requested by the as recommended by the Nasmum Committee, they brought it to the 8%. Next, deregulation of interest rates. The next recommendation of the Nasmum Committee is deregulation of interest rates. That is, should be allowed to be determined by the market forces instead of the banks or this. So that is become much simpler. So scheduled commercial banks have now the freedom to set interest rates on their deposits subject to minimum floor rates and maximum ceiling rates. The interest rate on domestic term deposits have been decontrolled. The prime lending rate of SBI and other banks advances over 2 lakhs has been reduced. Yes, yes, children. This deregulation is that, as I said, the banks have been given freedom to make changes in the interest rates of their deposits. Generally, earlier RBI used to, but after whatever the raise, okay, whatever is there, that is based on the RBI. It's a minimum level here. That is, minimum floor rates will remain same. Minimum maximum floor rates will remain same. Will remain. So that is, sorry, I'll tell you. Deregulation of interest rates means banks have been given, commercial banks have been given freedom to set their interest rates based on the market demand. But at the same time, RBI government has given certain restriction. The minimum it should be to what extent, and the maximum it should not cross what extent. That minimum and maximum ceiling levels rates have been given by the RBI. Within that minimum maximum rates, the commercial banks have the freedom to fix the interest rates on their deposits up to depend. Okay, that is the reason why frequently interest rates, whenever interest rates of RBI changes, the interest rates in commercial banks also keep changes. Okay, that is again the freedom given by the government to the commercial banks. The next one is recovery of debts. Yes, how do they recover their debts? uh, we said there, in case of difficulty in recovery of debts, they're supposed to maintain some fund. Right here, how do they recover their debts? Earlier, you might have heard of this or don't know. Certain banks, in order to recover the debts, used to threaten the customers. That has to be removed. But financial institutions and the banks have been given certain instructions as formed through certain tribunals. They are supposed to collect their debts. It's not that you trouble the customer or threaten the customer and collect the debts through some measures. 6 special recovery tribunals and appellate tribunals have been set up at Mumbai, and through these tribunals, the banks are supposed to recover their debts in case if they find any difficulty. Next, competition from new private sector banks. Is this the another recommendation given by the Nasmum Committee? So, private sector banks already started functioning in a large scale. Okay, and these new sector banks, how do you face the competition? This thing they are allowed, they are supposed to raise their banks capitals, right? So how do they allow capital raise their capitals? They are supposed to be allowed to raise their capitals through some foreign source, FDIs. There came into existence some FDIs with some percentage of restrictions. To what extent FDIs can be allowed? With that restrictions, these foreign, sorry, private sector banks are allowed to raise their capitals. Access to capital market, yes, banking companies also allowed to trade in the capital market and issue the raise their funds by issue of shares and equities. The next one is freedom of operation. Scheduled commercial banks are given freedom to open that is delicensing of branches. In branches, they are given freedom to open the number of branches without any license, and where they feel convenient, they need to extend their business operations. Local area banks are given certain guidelines. The RBI has given certain guidelines for local area banks to be established by the private sector banks. Okay, and they are whatever in order to mobilize the funds and development of the rural areas. The RBI instructions, with the RBI instructions, localized banks can now operate their funds. Okay, it means operate their business operations. Supervision of commercial banks. In order to supervise the commercial banks, they established the Department of Supervision as an independent unit of supervision of commercial banks. So that's about banking reforms. I hope you all can see. The next one. We discuss this. First committee and the banking reforms. This is also done. After 1991, again Nasmum Committee has given instructions in 90. Again, some report, second report regarding the banking reforms, that is in 1998. In that report, what recommendations? And strengthening the banks in India. Current account convertibility. It's like a stronger banking system. And banks must be capable of handling problems regarding domestic liquidity and exchange rate management in the light of CAC, that is current account convertibility. Thus, it recommended the merger of stronger banks, which will have multiplier effect on the industry. So this is the one 1998. There came strengthening of banks in India. That is, let allow the stronger banks to merge and make sure multiplier effect on the industry. Next, narrow banking. Those days, many public sector banks were facing the problem of non-performing assets. As I just now said, non-performing assets means on non-recovery. In case of recovery of loans get difficult, they used to take over the assets, fixed assets, and which will not generate any revenue. They call them as a non-performing assets. Okay. So in case of such non-performing assets, for the successful rehabilitation of these banks, the Nasmum Committee has recommended narrow banking concept where weak banks will be allowed to place their funds only in short-term and risk-free assets. The next one is capital adequacy ratio. Strengthen the Indian banking system. Committee recommended the government should raise the prescribed capital adequacy norms. That is the reason why now we have capital adequacy, that is 10.5. This will further improve their absorption capacity also. Currently, capital adequacy ratio for Indian banks is 9%. That is in 98. Okay. Now at present, in 2022, if you see, it is 10.15%. Bank ownership, as earlier mentioned, freedom for banks in its working and bank autonomy. Now, the government control of the banks in the form of management and ownership and bank autonomy does not go hand in hand. So recommended review of functions of board and enable them. Like some autonomy body has recommended in the 91 recommendation, right? Now they said let banks work on their own. at a corporate strategy, because government control and independency of banks are not getting difficult to go on in hand. So let us review the functions of these boards and make the banks as a corporate strategy. Review of banking laws. Again, because according to the changing norms and the requirements, they said the Banking Regulation Act and banking laws has to be upgraded as per the requirements of the present banking sector requirements. Okay, these are the recommendations made by the Nasmum Committee. That's all. So now let us see. Commercial banks, central banks. The next our topic is central bank. Central banks. Just a minute. A brief introduction of central bank I already have given. That is, central bank is the highest banking system in India. It controls the credit, like functions of central bank or the Reserve Bank of India is important. So this one is central bank, which is an important banking system in India, and the high level banking system in India, the topmost banking system in India, which controls the functions of other commercial banks. Okay. Central bank control the credit, demand and that is demand and supply of money, or manages liquidity in the economy. The central bank controls the demand and supply of money, or we also can say manages the liquidity in the economy. This function, central bank will aim to achieve the economic development and stability, as well as the inflationary and deflationary pressures. Credit control reserve. Okay, before going to this credit control of central bank, let me explain you. Just a minute. Central bank RBI functions. Okay, let me see. These RBI functions are there. I can explain you RBI functions, but the thing is that, okay, before I go to the credit policy, let me explain you the functions of RBI. RBI, being a highest banking system in India, will perform various functions, like acts as a monopoly power of, enjoys the monopoly power of issuing currency notes. As RBI, being a topmost institute in the country, will issue currency notes, undertakes the issue of currency notes. Okay, and these issue of currency notes currency notes, monopoly. Only RBI undertakes currency, the supply of money and issue of currency notes. Yes. Huh. Why monopoly right? Because only RBI, being a largest banking system in India, undertakes the issue of currency notes, and by issue of currency notes, it controls the circulation of money in the economy. So demand and supply, it maintains the volume of money to be issued or supplied in the economy. Handling currency handling practices in the text, and makes controls the supply of money as and when it is required. Okay, by the next one is after this, the next function of RBI is acting as a superior banking system, bankers bank. Like RBI being in the highest bank in the country, acts as a bankers bank. That is, commercial banks lend money as a topmost organization in the country. All the RBI regulates and control the function of all other commercial banks. That is how RBI as a bankers bank. Bankers bank means what? All the commercial banks keep certain percentage of their deposits in the RBI in the form of reserves. So when the funds fall shortage, all these banks will approach the RBI. Okay, so and not only that, RBI acts as a controller and regulator of the other commercial banks. That's why it's a bankers bank. The next one is that agent to government, banker and agent to government. RBI is a banker and agent to government. How it is a banker and agent to government? Being a banker, all the government accounts are transactions are recorded and maintained by the RBI. RBI maintains all the government accounts and transactions, maintain accounts of government on behalf of the government. So it's a banker. Next one is banker agent. It makes payments and collects funds on behalf of. As a banker, it makes payments and collects deposits on behalf of government from the customers or the other agents. The next, not only that, advisor also. RBI being a good financial advisor to the government in making various financial policies. So that's how RBI is the third function of RBI is banker, agent, and advisor to government. First one is monopoly, the issue of currency, monopoly of currency issue. Second one is bankers bank. Third one is banker, agent, and advisor to government. The fourth one is it's what do you call lender of last resort. Lender of last resort means what? RBI, being a highest banking system in India, will helps all other commercial banks in providing financial assistance. In providing financial assistance as a lender of last resort, because if any government if any bank, commercial banks fall shortage of funds, they can go to the RBI, and there came into existence repo and reverse repo rates. Okay, they take loans from the RBI. Okay, and whatever the loans they have taken and whatever the rate they have taken, more than that rate, again they will provide interest loans to the public. The repo rate and reverse repo rate. Here you'll come across of the repo and reverse repo rates. Okay. The present repo rate is around 6 rupees, 5 rupees 60 paisa, or 5 rupees 65 paisa something. Okay. Reverse repo rate is that reverse repo rate almost reverse repo. If the banks give loan to the RBI, reverse repo, the RBI takes loans from the, sorry, commercial banks takes loan from the RBI, okay, and sometimes RBI also takes a loan from the commercial banks. Then that is reverse repo, okay. So this reverse repo, yes, that is interest rate that RBI pays to commercial banks. We call as a reverse rate. RBI interest rate that RBI paid to the on the deposits of the commercial banks, whatever the interest rate RBI pays, that is called as a reverse repo. Whatever it charges upon the loan given to the commercial banks, that is called as repo rate. Okay. What we are talking? Yeah. Bankers, bank, lender of last resort. The next one is credit controller. Yes, there comes into existence the main function of RBI, credit controller. RBI plays an important role as a credit controller. Actually, commercial banks create credit, right? Commercial banks create credit, whereas RBI regulates credit. Whatever the credit created by the commercial banks, that is controlled by the RBI through various techniques. Okay, qualitative techniques, quantitative techniques, like that. With the help of various techniques, RBI tries to control the credit, which is again an important topic of your subject, that is of the credit control of RBI. So that's going to be shared. I'm sharing you this screen. Is this screen visible to you all? So today's class, I'm going to explain you about credit control by RBI as one of the functions. Anyway, you'll able to write. I just explained brief the functions. Functions: bankers bank, monopolist of currency note issue, agent, banker, and advisor to government, lender of last resort, credit control. Whatever the credit control function is there, upon that we are going to talk about in detail the credit control by RBI. In order to control, the commercial banks create credit, whereas RBI controls that credit. So with the implementation of certain tools and techniques, qualitative and quantitative tools and techniques, RBI tries to control that credit that is created by the commercial banks. So let us see those tools and techniques. Basic objective: why to control? First of all, before we look into this tools and techniques, why RBI would like to control the credit by commercial banks? First, in order to attain the stability in internal price levels. The next, to foreign exchange stability, to bring the stability in the foreign exchange, and to maintain stability in the money market, liquidity control measures, and to promote overall economic growth and development, to promote national interest. With these objectives, RBI would like to control credit creation of commercial banks. So as I mentioned, we have two quantitative methods, qualitative methods. Quantitative methods influences shows the influence on the how the influence on the quantity of money supply. Qualitative methods show influence on the direction in which the money has to be utilized by the commercial banks. So RBI tries to increase or decrease the amount of credit money available in the economy. So we are going to discuss about quantitative methods. Bank rate policy, open market operations, repurchase transaction, variations in the reserve ratio. So bank rate policy, first one, or discount rate policy, we also call rate at which RBI lends money to commercial banks as a lender of resort. We call as a bank rate. That is what commercial banks when they fall shortage of funds, borrow money from. As an individual we borrow money and take loan from the commercial bank. Same way, when commercial banks find shortage of funds, will borrow money from the Reserve Bank of India. So commercial banks, for the commercial banks, when RBI give loans, upon that the rate whatever is charged is called as bank rate. Okay, the standard rate at which the central bank is ready to purchase and rediscount eligible instruments like government approval bills and commercial papers. So it is lends money to commercial banks, and we also call the rate at which central bank is ready to purchase means from the commercial banks. It buys the commercial banks documents, instruments, bills, commercial banks. In previous class, I explained you bills of exchange means commercial banks accept the bills of exchange and give advances. That again, commercial banks will keep with the RBI and take the advances. So, at what rate that advance has to be accepted and provided is that we call as a bank rate. It has great influence on the availability of cost of credit. Increase in bank rate, increase the cost of borrowing. It forces the commercial banks to increase their lending rates. I'll give you a small example. See, A, B, C, or I am the faculty, RBI say, and you are the commercial bank, and your next one is the customer. Now, as a commercial bank, you want some money. Okay, you already have given some advances by keeping some bills of exchange or some instruments, and you are given money. And now to your next one, you want to give some lend some money. You don't have the funds, so you came to me. Then what I do? As a RBI, I'll see whether in order to control the money supply and to control the cost of credit, because at what rate I'll give you money, based on that you are going to give the money to your next one. Yes or not? If I charge 10 rupees, what amount you charge to lend money? 12 rupees, right? You will charge 12 rupees. If I charge 8 rupees, you will charge 10 rupees. But as a commercial banker, whatever the rate you borrowed from RBI, the same rate you will not lend it to your customer, right? So RBI as an controlling body, what I'll do, I'll try to control the rate of interest, the circulation of credit creation by this through this rate of interest that I charge upon your loans. If I give higher rate of interest, automatically as a commercial banker, you will also lend at a higher rate of interest. When higher rate of interest is there, public will not come to you to buy your to borrow from you, right? So that is what here one of the technique that the commercial Reserve Bank apply in its credit control measures. Look at these points again. It has a great influence on the availability of cost of credit. Why available cost of credit means, if you see a customer came to buy a vehicle, if you are giving it a 6 rupees interest per annum, he will show interest. If you are charging 10 rupees, will he come forward? No, because cost of credit is more, right? Same thing here. It has great influence. This bank rate policy. This rate is announced by central bank at regular intervals in order to respond to the market conditions. So, depending on the supply of money in the market and the circulation of money in the market, bank rate will keep changes. As a RBI, I don't continue the same rate. Okay, if many people are coming forward and demanding for things, I'll see is there really necessity or not. Then to control that money circulation and to control more inflation rates, I'll charge according to the market conditions. Increase in bank increases the cost of borrowing. It forces commercial banks to increase their lending rates and discourage the borrowing from taking loan. Hence, the ability of commercial banks to create credit decreases and vice versa. Just now, with that small example I explained you, the same thing here. The next one is open market operations. Open market operations again means RBI, as an RBI, what I do, I come forward to buy the bonds or the securities that are trading in the see, first I'll government bonds, whatever are there in the circulation, I'll buy whenever there is a shortage of buy. Yeah, when there is a shortage of supply of money, and I'll sell when there is more supply of money, so that I control the supply and demand of money. That is open market operations. Simple. Then open market operations refers to the sale and purchase of government securities and treasury bills by the central bank of the country, regulate the supply of money in the economy. Open market operations directly affects the supply of money in circulation and cash reserve ratio of commercial banks. Sale of securities by central bank to commercial banks reduces the reserves of commercial banks. Yeah, simple. You might have faced the situation like when you have so much of money. See, you are earning your income is 10,000, and you are spending lavishly, means without giving your money the home to your mother. Then your mother told you very politely, beta, money थोड़ा खर्चा कम करो, सेव करो. सुनते हैं आप लोग? नहीं सुनते. मम्मा छोड़ दो. बाद में और सेकेंड टाइम देखे. So again she told you, बेटा मुझे थोड़ा मनी पैसा होना है मेडिकल मेडिसिन के लिए, नहीं तो मेरा कुछ खर्चा है. तो क्या करते हैं, मक्को नहीं मम्मा बोलते हैं, नहीं बोलते ना. So like that she collects some money from you to make you cut. And whenever you find shortage of money, what she'll do? She will give you the money to you. Same way here, what the banks do, RBI do, it collects, means issue the commercial government securities and treasury bills to the commercial banks and sell those from the commercial banks whenever it feels commercial banks have a more supply of money. By selling, it collecting the money and issuing those documents. And when commercial banks finding shortage of funds, it comes forward to buy those treasury bills and securities. And by buying, the commercial banks raise the funds again. That's how the central bank controls the supply of money in the market by the commercial banks. Variations in reserve ratios. Children, please don't go. I hope I'm making you understand the topic. So please be here in the class, only don't leave. I too, it's a Sunday for me too, right? Sorry. So variations, reserve ratios, and legal reserve ratios. About this, I already explained cash reserve ratio and SLR, statutory liquidity ratio. The more the reserves the commercial banks are asked to maintain, the lesser the credit they can create. The lesser the reserves they maintain with the commercial RBI, the more the credit they can create. So depending on the money supply in the market, the RBI time to time change these reserve ratios, the reserves to be maintained by the commercial banks with the RBI. Okay. Legal reserve ratio means cash reserve and statutory. Cash reserve is deposited with the RBI, statutory kept with them themselves only. This, when, I said wrong, ulta in previous slide. Cash reserve, the reserve which they are supposed to keep with the RBI, and statutory liquidity ratio, which they are supposed to maintain with the bank itself to meet their requirements, daily requirements. I explained here about that also. Whatever I said, the more you deposit, the more you reserve you maintain, your RBI asks you to maintain, the lesser the credit creation by the commercial banks and vice versa. I explained this all there. Repo rate, next the other one is repo rate and the reverse repo rate. Repo rate means the central bank offers money to commercial banks. Shortfall of funds means when commercial banks come forward to raise the loan from the commercial bank, sorry, the RBI, then the rate of interest that is charged by RBI is repo rate. Remember, the rate of interest that is charged by RBI is repo rate, and the rate of interest that is paid by RBI to the commercial bank is reverse repo. Remember that, children, charge and paid. Okay, when you charge, when you give the loan, when you pay, when you deposits are with you. So RBI, whatever the rate of interest charges on the loans, that we call as a repo rate. A reverse repo rate means when RBI paid interest on the deposits of commercial banks, that is reverse repo rate. So by making changes in these rates also, RBI controls the credit. See, RBI, you are a commercial banker. You came to me for a loan. I thought, array, he is making so many loans and creating more demand for the money and creating a lot of problems. So I said, 10 rupees is the interest rate. Then okay, you said, and you collected loan from me, and your customer you are charging 12 rupees. Then how many customers will come to you? Those who are ready to come for 12 rupees of it, because cost of credit is more. When cost of credit is less, then only customers will come forward to take the loans. So that is how commercial bank, the RBI controls the lending power of commercial banks through these repo and reverse repo rates. Next, we have qualitative measures like giving instructions, fixation of margins, credit rationing, regulation of consumer credits, control through direct moral suasion, publicity, direct action. These are the certain qualitative measures that the Reserve Bank undertake to control the credit. Okay. More the quantitative measures are more effective than the qualitative measures. That's about credit creation by RBI. The next topic is demonetization. With that, I'll stop my today's class. Are you there? The number is decreasing one by one. Yes. I have to convert my PPTs to PDFs. Then I'll send you, children. Don't worry. Let us complete our syllabus first. Okay, and only let me know whether you are understanding or not, so that my next class I can improve much better to your standard. That is what I want. Today's class, again, a demonetization, a conceptual framework, which you can expect in the examination also. Okay. Okay, ma'am, you said, but you didn't tell me you understood or not. Whatever I asked. Yeah. Demonetization from so under the commercial bank block 3 you will get a RBI, right, central bank. From the block 3 you will get what is the central bank and the functions of central bank, credit creation techniques of central bank, and then demonetization. These are the topics which you can expect from the third block. History of Indian currency. If you see Indian rupee, Indian rupee is an official currency that is used and accepted in the Indian country. This Indian rupee we can divide into various denominations, and okay, rupee. A rupee is divided into again paisa. Okay. And the monopolistic authority of issuing these currency notes in India has only by the Reserve Bank of India. We have so earlier we used to have silver coins and little gold mixed coins also in the 16th century. Later on, now Mughals came, and they also. This is our first Indian rupee appears to be. And later on, we have these number of currency notes in India. These types of currency notes. In 2010, we got a symbol for Indian currency, which is rupee, which is taken from the Devanagari consonant, Latin capital letter, mix of these two. The parallel lines at the top with the white space between them are said to make a reference to the tricolor Indian flag. Have you observed this rupee sign? This is not the rupee sign. From Devanagari consonant and from the Latin capital letter R, our Indian rupee sign has been developed. Okay, in that top of that rupees, and here you will get one more line actually in the rupee symbol. So that indicates our tricolor Indian flag and also depict the equality sign that symbolizes the nation's desire to reduce economic disparity. Okay. Now let us come to the demonetization. You all know about this the demonetization withdrawal of a particular withdrawal of 500 notes has been declared on 8th November 8 p.m. That is at midnight of 9th November. 500 and 1,000 notes have been banned by the government. A sudden demonetization of these currency notes we are feeling, but it has been earlier also in the year 1946 and 1978. The 1,000 rupees note have been demonetized. And did you ever have seen 10,000 note? Highest denomination ever printed by the RBI, that is 10,000 note in 1938. Denomination printed, but in the 1946, it has been demonetized. Had been. Banker notes of 50,000, 5,000, 10,000 were reintroduced in the 1954. This is all history of demonetization. So, as I mentioned, the sudden move to demonetization of rupees 500 and 1,000 currency note is not new. It has happened earlier also. In 1946 and 1978, 1,000 note had been demonetized. Again, the 10,000 note, which has been printed by RBI in the year 1938, has been demonetized in the year 1946. Then 1,000, 5,000 and 10,000 notes have been reintroduced in 1954. 1946 demonetized. 1954 reintroduced. Okay. Again 1978 demonetized. So like that, but the reason behind this, what is demonetization? Okay. This is the latest one which we all know about it. So what is demonetization? Demonetization is the act of stripping a currency unit of its status as legal tender. Means whatever currency note Say also currency note is demonetized means you cannot use it as a means of exchange. You cannot use it as a means of exchange in your purchase, and your purchasing power loses. Legal tender, stripping off means cancelling the legal tender value for that currency note. So demonetization involves either introducing the when we do that, to introduce a new note or coins of the same currency, or to cancel the total completely that particular currency. We demonetization involves either introducing new notes or coins of the same currency, or completely replacing the old currency with the new currency. Okay, like see 500 and 1000 demonetized. New 500 notes have been replaced. 5,000 1,000 note has been totally cancelled. Okay. So it can be either that cancelling the totally that particular currency note, or replacing the old currency note with the new currency note. That is new. That is called demonetization. So what is the reaction of the people? Mixed response. Some people admired the step while others criticized it. Here I will give what the different people have mentioned about this. Former Vice President and economist Kaushik Basu said major mistake. And Indian American economist Jagadesh praised the demonetization. The next, reasons behind why governments go for demonetization. If you talk about the present scenario for the demonetization, to curb the menace of black money, or to eradicate the corruption, and to stop the circulation of counterfeit currency, and to fight tax evasion, to combating inflation, and establish a cashless economy, digital India. Black money. First, to curb the menace of black money, corruption, eradication, and to stop the circulation of counterfeit currency. Means this fiat currency means which is existing but not in the form of hard cash. To fight against the tax evasion means escaping the tax and all. Combat inflation, to reduce the inflation, and to make the India as digital India. Let us see the impact. In tribal, inherited and urban areas, everyone has got impacted with the demonetization in the Indian economy. Okay. So with these economic activities related to production, consumption, exchange, everything has affected. Right from the city, urban places to the tribal places, every consumer, every Indian has got affected with this. It has some positive impacts and it has some negative impacts. Let us see about these positive impacts. Cashless society has led to cashless society. Everyone started using the technology effectively. Sorry for the misalignment. Okay, corruption of and official and black money holders have been caught up, because when they declared the demonetization, immediately those whatever the 500,000 notes, it became very. They have to convert them. When they have to convert whatever the reserves they have, they come forward. They have to openly tell, or through some people they did it. Okay. The fall in real estate prices has taken place, and tax evasion cases are declared decreased. Okay. Tax evasion cases have been decreased. Okay. The next one is terrorism activities has decreased, because unless you convert that or you hand over that money, you cannot exchange it, you cannot trade with it. So that's how it became difficult. Next, importance to soft money, risk associated with handling hard money has minimized. Poor people or lower middle class, many religious institutions have kept donation boxes open for the people who cannot meet their daily necessities. Trafficking has decreased. Coming to the negative impact, cash crunch in the economy, 1.3 billion citizens under disabled this, all the economic activities, cash shortage in ATMs and bank we have faced, cash crunch, daily wage earners have faced a lot of problems, faced many carrying our small transactions, like digital India. Digital India carrying of small transactions through digital payments became difficult. Uh, Next one is petrol pumps. Yeah, these all various problems they faced. Short-term impact, if you see possibility of economic slowdown. So when this demonetization introduced, there are certain impacts. Means they can. Yeah, just I'm winding up. Please bear for 2 minutes. So short-term impact will be there, and long-term impact also will be there due to this demonetization. If you look into the short-term impact, economic activities will get slowed down because still the people get short-term recession will be faced. Demand will reduce. Okay, interest rates reduces. GDP formation will be affected. And if you see the long-term impacts, cashless society made possible properly. If you implement demonetization properly, fiscal position of the country will improve, and bank interest rate, real estate rates will properly, as per the requirements of the market conditions, transparently can be handled. Bank savings will increase. Demand digital transactions will increase. So this is promoting digital India. Part of this promoting digital India, this demonetization has been with this long run and short run impacts are there. Whatever finally, slowly the public has been adopting themselves to use them, but still it takes a long time to adopt for this digital India. So even though it is evident from above that due to the demonetization of our country faced a number of problems, advantages are more than the disadvantages. So India is running towards the digital economy, which brings potential change and shape to our country for the better citizen of India. So this is about our, from these I have taken, this is my reference. Right. Thank you, children. We completed our third block. In the next class, we are going to talk about please don't move, don't go. What is this this number, children? If you join the class, if those who will be there till the end of the class, for them only I'll give the notes. The last class I'm going to give you all my notes, but those who stay till the end only for them. And I don't allow the others to share also. If you share, you are also not going to get your notes. Remember that. Don't make me to threaten you. Understand why I'm saying this. And please maintain the strength till the end of the class. Okay? Right. Thank you, children. Thank you for being here. Except Aisha, I'll not get reply from anyone else. Only Aisha and Saida, Fatima. Saida, Fatima. These are these are only the few students who are attentive and stay till the end of the class. This used to be in my class earlier semesters also. Are you there in my previous semester classes? Yes? Right. Very good. So be there. Once you join the class, till the end, be there. But the last class is only to share your notes of all these topics and giving you some inputs for examination. Okay? Right. That everything at the end, last class. Only to those who stay till the end. And those who are there from the first class to last class. Others, I will make them leave the class. Then only to these particular students who are there from the beginning to end and from first class to last class will be allowed to stay in the class and will take the inputs. Convey this to your friends who are in the group. And okay, right. Thank you, children. Thank you. Have a great day, weekend. Bye-bye. Right. Bye, children. Let's meet in next class again next Thursday.